January usually tells us one thing about the housing market: who's ready to move. And this January didn't behave the way most people expected. Sellers didn't rush back, inventory didn't rebuild, and buyers didn't disappear. They got more selective. And once you see how those choices are showing up in the data, the rest of 2026 starts to make a lot more sense. I'm breaking down what the data actually says about supply, demand, and pricing in San Diego, why this market feels the way it does, and what it means for you going forward. Because if you're waiting for clarity before making a move, this is where it starts. All this covered in this week's San Diego Market Matters, and I'm Karl Kyler, your San Diego Realtor. If you haven't liked and subscribed to the channel yet, here's your chance to do so now or forever hold your peace. Just kidding. Either way, I appreciate you being here and watching. Now, let's jump into this. Let's kick things off with the new listing data, because this is where seller behavior shows up in real time. Every year, we expect December to be soft and then January to rebound once the holidays are over. That pattern did happen again this year, but the magnitude of that rebound is where things started to look a lot different. In January 2026, we saw 1,619 new detached listings and 1,088 new attached listings. That's down roughly 21% year over year for detached homes and almost 17% year over year for attached. So while listings did come back after December, they came back meaningfully weaker than they did in January of 2024 and January of 2025. What's important here is that January is usually when sellers make a decision. It's the reset month. If sellers are confident, January tends to overshoot to the upside. That's exactly what we saw in both 2024 and 2025. But in 2026, the positive growth trend broke, and it broke significantly. This tells us something important about seller sentiment. Sellers aren't rushing back to the market just because the calendar has flipped and reset. Even with mortgage rates stabilizing to the low sixes and buyer demand improving through buyer applications, many homeowners are choosing to wait rather than test the market aggressively. This is an example of intentional restraint. And this slowdown is happening in both detached and attached homes, which matters. When both segments move together like this, it points to a broader confidence issue, not just an affordability pressure in one slice of the market. Sellers across price points are hesitating all at the same time. The reason new listings matter so much is because they set the ceiling for everything else that follows. When fewer homes come to market, buyers simply have fewer options. And when options shrink, competition doesn't need to explode for pressure to build. It just needs demand to, at the very minimum, stay steady or consistent. A pullback in new listings like this it's not exactly catastrophic at this level, but it is consequential. It quietly limits choices. It shapes new negotiation power, and it sets the tone for how tight or flexible the market can be in the months ahead of us. This is how markets quietly tighten, not through panic, not through headlines, but through restraint. And January 2026 gave us a very early sign that sellers are still holding the line. Moving on, let's talk about total inventory. This is where the new listing story either gets confirmed or contradicted. And in this case, it's confirmed. As of January, we're sitting at 2,272 detached homes for sale and 1,799 attached homes for sale. Year over year, that puts both segments down, which lines up directly with the slowdown we just saw in the new listings. What really stands out here is how little inventory actually grew from December to January. We're talking roughly 50 homes in each segment. That's stagnation if I've ever seen it. And compared to how January started last year, this is a radically different setup. In early 2025, inventory was expanding quickly. In early 2026, it's already struggling to rebuild. This tells us something important about the structure of the market. New listings are weaker and inventory is no longer getting the relief it did last year. That means the market is quietly tightening. Fewer sellers are stepping in and the inventory that exists isn't growing fast enough to change the balance. This is where negotiating power begins to shift. So if you're a seller watching this, here's what matters for you. Your competition looks very similar to last year in terms of total inventory, but the buyer pool is actually healthier. Mortgage rates are sitting in the low sixes instead of the high sixes or low sevens, this time last year, which qualifies more buyers and improves affordability at the margin. That combination together gives well-positioned sellers a cleaner opportunity than they had a year ago. If you're a buyer, this is an early warning sign, sorry to say. If inventory continues to stall like this and rates continue to inch down, which we expect, competition doesn't ease, it builds. Fewer homes, more qualified buyers, and improving sentiment is how markets quietly shift from patient to competitive. That doesn't mean rush, but it does mean strategy matters more than it did last year. Now, scooting on, let's talk about pending sales. This is where buyer intent becomes real. Listings and inventory tells us what's available. Pending tells us what buyers are actually willing to commit to. Starting with the attached market, this is where things get interesting. Attached pendings are down about 10% year over year. And that decline isn't because there aren't enough homes to buy. As we just covered, attached inventory is essentially flat compared to last year, with only a marginal increase of 50 homes. So when pendings fall despite similar supply, that points directly to demand softening in that segment. Spoiler alert, you're gonna see exactly how soft it's gone when I cover the median average price. So with that being said, this decline tells us attached buyers are being more selective. Even with slightly better rates, that buyer pool is still more payment sensitive and more cautious. They're not gone, but they're slower to commit, and that hesitation is clearly showing up in the data. Now compare that to the detached market, and the contrast is sharp. Detached pendings are actually up year over year. More homes are going into escrow than last January, even though we have fewer new listings and roughly the same level of inventory. That means demand is strengthening into tighter conditions, folks. This is a key signal here. Buyers are not waiting for more options. They're competing for what's already on the market, especially in the detached space. That lines up perfectly with what we talked about earlier. Rates in the low sixes are enough to bring more prepared buyers back, and many of them are prioritizing the detached side of the market when they do. Another reason why we're seeing less pendings in the attached side. When you put this all together, the story becomes as clear as muddy water. The market isn't moving in one direction across the board. It's segmented. Detached homes are seeing improving demand with limited supply, while attached homes are seeing slower absorption despite similar inventory. This divergence, this separation matters for pricing, negotiating, and strategy when moving forward. Pending sales are telling us that buyer behavior is shifting first, and inventory hasn't caught up yet. And when demand moves before supply, that's usually a sign that the market is about to change its tone. Up to this point, we've been talking about behavior, what sellers are choosing to do, what buyers are choosing to commit to. Pending sales told us where demand is showing up and where it's pulling back. Now, the natural next question is this: when those offers get accepted, what are buyers actually paying? Because prices don't move first, behavior does. And the median price is where all of that behavior finally shows up in the numbers. Enough dangling the carrot in front of you, let's jump into the median sales price. Starting with detached homes, the median price in January came in at $1,070,000, which is up 2% year over year. Now, that might not sound dramatic, but context matters here. We're seeing higher prices while new listings are down and total inventory is flat to lower. This is the first sign that buyers are willing to compete for detached homes, and they're doing it without needing prices to come down to make deals actually happen. This lines up perfectly with what we just saw in the pending data. More detached homes are going into escrow despite tighter supply. That kind of demand pressure doesn't push prices lower, it stabilizes them, and in many cases, it nudges them up higher. That's exactly what the median price is reflecting here. Now compare that to the attached market, the story changes. The median price for the attached homes has dropped to $632,000, down about 4.4% year over year. That decline is meaningful, especially when you remember that inventory in this segment hasn't materially increased. Buyers aren't being overwhelmed with options. Personally, I think a lot of buyers in this segment are choosing to rent longer, or they're staying with their parents to save money. But that's just my read after 21 years in the business. Seriously though, this tells us that buyers are pushing back. They're negotiating harder, they're waiting longer, and in many cases, they're only moving forward when the pricing adjusts. That makes sense. Cash buyers tend to be more price sensitive here. And even with rates improving, affordability hasn't shifted enough to draw them back into the market to compete like the buyers on the detached side of the market. So when we put both sides together, median prices confirming what Penny's already told us. Detached homes are seeing firmer demand and stronger pricing power. Attached homes are seeing softer demand and more price sensitivity. Same market, different outcomes. Now, median price doesn't predict where the market is going. It confirms where the leverage currently sits in the market. And right now, leverage is currently segment specific. If you're watching this market closely, this is the kind of distinction that matters far more than the broad headlines about prices being either up or down. Now, for the average sales price data, this one's going to be quick because it's doing more confirming than explaining. For detached homes, the average sales price in January came in at about 1.44 million, up about 2% year over year. That's modest growth. No spike, no surge, and that's important. If higher end buyers were suddenly flooding back into the market, the average price would be moving faster than this, but it's not. So this is a good sign. For the attached side, the average price dipped slightly, down about 1.4% year over year. Again, nothing dramatic here, no collapse, just continued softness. And that lines up exactly with what we've already seen. Weaker demand, more price sensitivity in the attached segment. This is what average price is telling us here. There's no extreme behavior happening at either end of the market. We're not seeing luxury buyers distort the data, and we're not seeing distressed sellers dragging prices lower. This is a very measured market here based on the data. The median price shows us where the leverage sits. Average price tells us how aggressive that leverage is actually being used. And right now it's being used pretty carefully. And that's important because it reinforces the bigger theme of the entire data review. This market isn't making loud moves. It's making very quiet ones, tightening through restraint and not volatility. Now, before we go into the so what, if you're a buyer or seller, I want to zoom out and look at the total market overview because this page confirms everything we've been talking about, but it does it all in one place. Starting with supply, new listings are down just over 19% year over year, and homes for sale are down about 11%, while the months of supply has dropped from 2.4 to 2.1 months. This tells us inventory is not rebuilding, it's tightening. Sellers are still holding back and the market is feeling that absence. Now, looking at demand, pending sales are only down 3%. That's a big deal there. Buyers didn't disappear, they're just pulling back slightly. When demand softens a little, like we just saw, but supply pulls back a lot, the balance of the market shifts. And you can clearly see that shift show up in the prices. Median and average prices are both up 2% year over year, even though closed sales volume is down nearly 14%. Fewer homes are selling, but the ones that do sell are holding their value. Key point there. We're also seeing the market slow just enough to breathe. Days on market ticked up from 45 to 48 days, and sellers are still receiving over 97% of the original list price. That tells us negotiations exist, but leverage hasn't flipped quite yet. And putting this all together, the message is very clear. This market isn't frozen. It isn't crashing either. It's tightening quietly. Sellers are cautious, buyers are selective, and pricing is being supported by limited supply rather than fueled by hype. And that's the setup heading into February and March, which is where the real decisions start being made, AKA the market starts to heat back up again. Now, if you're a seller, this is a market that rewards preparation and strategy, not guessing. And if you're a buyer, this is the window where leverage still exists, but it's narrowing fast, especially depending on what segment you're in. And that's a wrap for this week's San Diego Market Matters. I hope that this data helps you make a more confident decision in your next move. Now, if you have any thoughts, any questions or concerns, don't hesitate to reach out to me directly. And don't forget to like and subscribe if you haven't already. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.